What if you do want to pick an individual company you believe in? This is where you need to learn to separate the truly great businesses from the just okay ones. Exactly. When you see a successful company, the first question you have to ask is, what's stopping someone else from coming along and doing the same thing, but cheaper? If you can't answer that question, it's a big red flag. The answer to that question is what legendary investors like Warren Buffett call an economic moat. Think of it exactly like a castle. A moat is a durable, long-term competitive advantage that protects a company from its competitors. It's the reason a company can stay profitable year after year. And it's the number one sign of a high-quality business. According to research from Morningstar, companies build these moats in 5 main ways. First up, you have intangible assets. This is stuff you can't physically touch, but has immense value. Think about Coca-Cola's brand and secret formula. You'll happily pay more for a Coke than a generic supermarket cola, right? That brand loyalty is the moat, and it allows them to protect their profits. Next is cost advantage. This is simple. The company can make or sell its products cheaper than anyone else. A great example is McDonald's. Because they buy so many potatoes and so much beef, they get them at a massive discount that a local restaurant could never get. As an investor, that low cost means higher and more reliable profits for the business. Then there's one of our favorites, switching cost. This is when it's a huge pain, hassle, or expense for customers to leave a company for a rival. Think about your main high street bank. Switching is a hassle, right? That hassle is the moat that keeps customer locked in. Another incredibly powerful one is the network effect. This is where a service gets better and more valuable for everyone as more people join. Visa is the classic example. The more people who has Visa cards, the more shops have to accept them. The more shops that accept them, the more essential the card becomes for you. It's a cycle that almost impossible for a new company to break into. And finally, there's efficient scale. This usually applies in niche markets where it just wouldn't make economic sense for a competitor to show up. Imagine a company that owns the only pipeline running from a port to a major city. A competitor isn't going to build a second one right next to it. That basically has a natural monopoly. So how does knowing all this help you pick a company? It's a critical bridge between a company story and its financial performance. When you see a company with amazing profits, the moat answers the most important question. Why are these results so good? And are they sustainable? A strong moat is the best evidence that you have that a company's success isn't just a fluke, but the result of a durable, long-term advantage you can invest in.